All right, folks, how we doing? Here we are, 1:30 here in Chicago. As promised, I said that I would have a short discussion on the implied move. There was a question that came up on what do we mean by the implied move and how do we get it. All right, I want to make sure you guys can hear me okay. If you could just give me a quick yes, if you could. Thank you. All right. Okay, so the whole premise of you'll hear it called measured move, implied move. A very quick way to do that would be just to find the at the money straddle. The thing is sometimes we're not at the money. If you have $2.50 wide strikes and you're in between the two, well, then it's kind of hard to get what the actual implied volatility is at the money. But we have tools that can do that for us. Oh boy, U.S. grounded 737s for Boeing. That should be interesting, folks. Let's see here. It's down 2% right now. Okay, so at any rate, we'll see what they want to do. But the FAA just grounded all the 737s for Boeing. That's not good for Boeing stock. Okay, so getting back to what the implied move is, and what we use here is we have the Prosper Trading Options Trading Tool. That is in the Documents tab. So that is always there for you guys to use and play around with. As with all of my computational spreadsheets, anything in yellow, feel free to type away. Anything in white, don't type in it. That means you're going to probably go over a calculation, a formula, a reference cell, something along those lines. Okay, but so what we're able to do with just 3 pieces of information, we're able to figure out we can get a price distribution. Okay, so let's just say, all right, we got, now let's not use Boeing because it's moving all around here. Let's look at EA since we have a position in EA. Now, what you use is you use implied volatility, and implied volatility is derived from the price of the options. So you have people that actually have skin in the game determining what the implied volatility is. If somebody deems implied volatility too cheap, they buy options. If they think it's too expensive, they sell options, and that's where we have our price discovery, and that's why we have one of the reasons why we have exchanges and marketplaces, price discovery. Okay, so let's pretend that we're going to go out to April. So it'd be 3 pieces of information. You need underlying price. So here we are trading $100.35. Let's go out to April, which is the 18th, and then we need the at the money implied volatility. Sterling Volatrader does this for us, which is here. Now every platform is going to have, you're going to be able to get implied volatility, whether it's how easy it is to get, that's maybe a different question, but you're going to be able to get some measure of it, and all of the everybody's model is a little bit different, so implied volatility can be a little bit off from each other. Scott and I both use Sterling Volatrader, and we're comfortable with the implied volatilities there. It's just a matter of comfort. But anyhow, looking at the April 18th, that implied at the money volatility is 36.8. So 36.8. So now, given those 3 pieces of information, we are able to get a price distribution. Over here on the left is standard deviation. Over here on the right is a dynamic where you can put in a confidence interval. So you can, if you want to be more conservative in your estimate, well, then you use a lower confidence interval. If you want to be more certain, then you use a higher confidence interval. Of course, the higher the confidence interval is, and for those, for those that aren't comfortable with what a confidence interval is, I just highlighted that piece of information that's in the room now. So you guys can click on that. But essentially what a confidence interval is if something has a 50% confidence interval, that means that 50% of the time, statistically, the mean of the distribution is going to be covered in that distribution. So so think of a standard deviation as a 68% confidence interval thereabouts. There's it's a little bit more than 68%. But what I like to use, I like to use a 59% confidence interval, and it's just again a matter of comfort. Why 59? Well, it's basically between 50 and a full standard deviation. Okay, so you can so given this, so for example with EA, given that we're trading $100.35 for April expiration, that implied volatility is 36.8. Basically, 68% of the time, our ending price is going to be above 88.75 and below 111.95. 59% of the time, it's going to be above 90.09 and below 110.61. So that's how we use implied volatility to, and so what are we trying to do? This is what we use to derive our target prices for our strikes. We want to be reasonable. Well, what's reasonable? Well, this is what the statistical measures show. This is reasonable. Can EA go to 135? Certainly can. Can it go to 0? It can. Will it do that? Probably not. And so that's where we use statistics to figure out what is reasonable. Remember, we trade in the realm of probabilities, not possibilities. It's possible it goes to 1,000. It's possible it goes to 0. It's not probable, though. Okay, what questions do we have on that? I want to make sure that that we covered that and that it's clear. It's definitely one of the central things that we use here, because once we determine whether it's a technical move, fundamental news, earnings, whatever it is, it's like, okay, great, we want to get long, we want to get short. Well, if that's the case, where should we target our move? And that's where we use the statistics to calculate that. Roseanne asked, what did I say that I used for implied volatility? I used implied volatility 36, at the time it was 36.8. It's now 36.9. But depending on what platform you're using, it's going to be displayed somewhat differently. It should be in the same ballpark. I mean, I shouldn't be talking about a 37 vol and you're talking about a 45 vol. But there's going to be little tweaks and so forth in the model, which will spit out a slightly different implied volatility depending on what platform you're using. As long as you're consistent and comfortable with it, it shouldn't matter. And like I said, it's not going. Remember, we're not trying to target an actual to the penny. We're targeting an area. So if I'm looking here, I'm targeting somewhere around the 110 or 111 strike. If you want to go out to if you want to be a little bit more aggressive, well, then a full standard deviation move would be about to 112 to the upside. So the expected move is $11.60. That would be a full standard deviation move. A 59% confidence interval would only be 10 1/4 or thereabouts. But exactly, Bob, you are absolutely right. And like I said, this spreadsheet is in the Documents tab, free to use. If you mess it up, don't worry. Get rid of it and then re-download it. All right, I did record this. If there are no more questions, I will get this video out to you as soon as possible. And Bob, you asked, approximately a full standard deviation move would be down to 189, or excuse me, just to 89, and to the upside about $1.12. That's where it's pricing itself now. That would be a full standard deviation move. All right, I think there's a couple more questions coming in here, so I'm going to leave the recorder on. Okay. Well, Bob just said thank you. All right, everybody, I'm going to get this video out to you. Please feel free to review it and ask any questions about it. But like I said, this is a central tenet to what we do here with swing trades. All right, folks. Thanks a lot.